Hello everyone. Today on the Final Bar, we'll wrap the week. On a Friday, we like to look back at the last 5 trading days, see what we learned. Overall, it's hard not to be encouraged by the rotation to the upside. Risk assets having a nice finish to the week. Not the strongest Friday, but good enough to wrap up a performance to be impressed with to the upside. Ladies and gentlemen, this is the Final Bar. Hello everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. The StockCharts platform really gives you a lot of capabilities to better understand the world around you as an investor, to focus on the key message of price and trend and momentum. I'm thinking about some of my conversations this week with people like Jeff Hirsch and Jesse Felder and others, really masters of their particular areas of the technical toolkit. It's great to see how they try to make sense of these markets using the same analytical tools that you have available on StockCharts.com, focusing on indicators and price and focusing on the message the markets provide back to us. Today we're going to look at a week that overall I think you have to describe as fairly constructive. The S&P right up at 4,200, threatening to break above there, but not quite pulling it off just yet. Having said that, let's get to our Wrap the Week segment and focus on how the markets have evolved over the last 5 trading days. I do want to start with a poll. We asked you recently on our live stream page at StockCharts.com, also on our social media accounts, which of these sectors performs best through year-end 2023? Energy, technology, consumer discretionary, consumer staples. I was wondering if I'd get any sort of defensive players betting on staples, any sort of bottom fishing candidates, bottom fishing sort of people looking for energy value investors. But 70% of you really went with technology. Now, again, if I voted on this one, I probably would agree with you, because what's interesting is technology has that fascinating mix of being arguably offense and defense. There's an offensive part of technology, and it's not things like Apple and Microsoft, although they certainly have upside potential. It's more of the emerging technology names, right? Things like AI and others that have, big long-term emerging growth possibilities. But there's also more blue chip sort of established names like Apple and Microsoft and big hardware and software and services names. So technology, not a bad guess. And what's interesting is it's done well in bull and bear market phases. So I have to agree with Final Bar Nation on this one. I think that's a good place to be focused if you're looking for an opportunity within some of those 4 sectors. Let's continue on with our Wrap the Week segment by looking at the markets today. What we'd like to do is just focus on what happened today. Then we'll connect that to the last 5 days, last 4 days, and see what the overall movement has been through the course of the week. Look at some of the charts and names that tell the story of what played out. The S&P 500 finishing just a little bit below where we were yesterday, sort of a choppy session. Yesterday, obviously a big move, and so today was sort of the lick the wounds day, I guess, if you're short, or maybe the digestion day is what we usually call it, right? The day after a big move, you often sort of have a digestion day where things sort of resettle, the markets sort of come up with the new value where the particular chart needs to be, and then it's sort of a recoup and reset, and then we see what happens next. The S&P finishing just below 4,200, around 4192. That's down 0.2% from yesterday's close. The Nasdaq Composite just down a 0.25%, so essentially unchanged for those two. Little steeper decline for the mid-cap and small-cap indexes, and that's been a chronic issue for the markets in 2023. Right off of the October lows of last year, 2023 overall has been a resounding success by most definitions for a lot of stocks, particularly the mega cap names, right? Look at the S&P 100 as a good example of that. But small cap's much different, right? The path of the small cap ETFs, like the S&P 600, Russell 2000, very, very different. The breadth indicators looking at small cap data, like the advanced decline line, much less attractive, much less constructive, really giving more of a bearish take than a bullish take, even with the nice move to the upside that we saw this week. So continuing to be an issue for this market, a lack of support from mid cap and especially small caps. The VIX bouncing back higher. Now, yesterday when the market rallied, the VIX rotated lower in a big way almost getting below 16, but not quite doing it. Today, bouncing back up to around 16.75. Just a quick take around some of the other asset classes. The yield curve out of the short end, sort of the mid to long end of the yield curve, all moving higher once again. So 10-year yields finishing the week around 369, 3.7%. 5-year yields around 375. The 30-year yield around 395. Dollar index down by about 0.25%. So not too much of a change from yesterday, but that stronger dollar has been one of the biggest challenges for gold prices. Weaker dollar today means gold and silver have room to move higher, and that's exactly what happened. The GLD up by about 1%. Silver prices up by about 1.4%. The rest sort of mixed, to be honest with you, with some of the energy-related ones down a little bit. Cryptocurrency is not too bad. Now, yesterday was a big, choppy day for cryptos. Today, a little more reasonable, a little lower volatility. So Bitcoin just below 27,000. Not too much of a change from yesterday. Ether around 1810, 1815 or so. And the rest sort of mixed, a little up, a little down. Let's look just briefly at a chart of the S&P 500. We'll check in on what happened with this market. I've talked with a number of my guests about this 4,200 level. And once again, we traded up to it, closed right there yesterday. Today, we opened and started moving higher. And I was sort of just, getting the pencil ready to write some article talking about, goodbye 4,200. It's in the rearview mirror. Didn't really play out that way, right? We closed back below 4,200. That might be an important tell going into next week, because one of the biggest sort of patterns we've often talked about is follow through, or more importantly, the lack of follow through. When an uptrend needs to start being questioned, it's when instead of breaking out and then following through and pushing further to the upside, when you break out and fail, right? What that tells you is that all the buying power was sort of used up, and we're sort of hitting the point, and there are no additional buyers willing to come in and push the price even higher. And that's when you have this pullback from an established resistance level. That's what this looks like so far. Again, that can change next week. We get a nice return to the upswing. 4,200 all of a sudden is below us, and it looks like a nice strong move up to at least 4,300, if not further. But we have to get through that first level first. So for now, not able to follow through just yet on that key number. Worth noting also the RSI right at 60, which is about where things top out if we're in more of a bearish phase. That might be an important indicator to watch as well. I forgot to look just quickly at the sector returns, just briefly going back to our dashboard. Energy up, healthcare up, materials up, and energy leading the way higher, up 0.8%. Everything else was basically flat to down for the day, with consumer discretionary leading the way lower, around 0.8%. Now, that's a bit of a mean reversion from what we've seen recently. In the last week or so, consumer discretionary offense has been outperforming consumer staples, which is more defense. That flipped today with consumer discretionary, the worst performing out of the 11 sectors, down about 0.9%, 0.8%. Let's go to the wrap the week chart. This is looking at the weekly returns starting the clock last Friday, looking to where we're at today. In black, we have the S&P 500 finished this week up 1.7%. Couple things outperformed the S&P this week. This is small caps, the Russell 2000 up 1.9%. In brown, we have crude oil prices up to just about 3% and up 3.5%. The best performer this week was the NASDAQ 100. Again, not a surprise if you've been following the markets in 2023. That's how things have felt pretty consistently. Everything else underperformed the S&P this week. In orange, we have the emerging markets ETF, EEM, which is up 1.1%. The dollar finished the week up 0.6%. Flat for the week, basically Bitcoin up 0.1, 0.2%. Gold was down 1.7%. Bond prices down 3%. So stocks still outperforming bonds. That's a long-term trend that at times has been questioned, I think, in the short term, but this week certainly continuing to press that bet of stocks over bonds. That has been the story for multiple years, and this week certainly not changing the trajectory of that particular move. Back on the dashboard, I love adding some of the charts that I'm most fond of and having them right on my front page, which is why I have these two charts. And just to go quickly through them, our market trend model remains bullish on all time frames. Long-term, medium-term, short-term, all in the positive. Last week, the short-term model was just barely remained bullish. It almost went to the negative, but it did not. This week, bouncing back higher. Again, nice week for risk assets, pushing our short-term model, just reaffirming that it's in the bullish phase. So short-term, medium-term, long-term, thumbs up at this point for the markets. That's certainly what this market has looked at. I'm not questioning the trend for over the last 6 months. I'm questioning the extent that this trend can continue much above current levels. That's my overall take on where we're at right now. As the S&P is testing 4,200, worth noting the advanced decline line on the New York Stock Exchange clearly sloping lower. And that is not a look that I think bulls should be really excited about. When the market is going higher, you want the advanced decline lines going higher as well. Now, the S&P, the NASDAQ 100's advanced decline line looks fine, but I think that misses the point of the issues are outside of the mega cap tech and communications names. It's the other stuff that's not really been performing as well. And I think you're still seeing that divergence, which is not a healthy divergence if you're optimistic here. About 50-50, it's a coin flip as to whether any stock in the S&P is above or below its 50-day moving average. About the same for the 200-day moving average as well. Point and figure charts are telling us about 55% in a bullish configuration in the S&P, which means 45% are still giving a sell signal. My friend Adrian Zadunchik from the Burb Nest shared a chart which I like, just looking a little shorter term at this ratio, seeing that offense starting to outperform defense. I agree with you, Adrian. I think that's an important chart to watch to see if that continues. On my time frame, a little early on to declare victory for the XLY over the XLP or the equal weighted versions that I'm using here, but certainly something to watch because the lack of performance in offense relative to defense, I think, has been a concerning development in these markets recently. I want to go through a couple of charts just to finish off our wrap the week, then we'll take a quick break. You know, Netflix is a really fascinating chart. When you think about those phenomena stocks, one of the 3 and 3 charts yesterday was the 8 phenomena stocks, showing how all 8 of them are basically above the 200-day moving average. And Netflix certainly, I would agree that that's the case. It's currently testing its February high. And what's so compelling about a market in this phase is the way that the market continues to go higher is you need more and more stocks making new 52-week highs. You need more and more stocks not just trading up to a resistance level, but trading through it. Netflix right now, I think, is still testing its February high. The more stocks like Netflix get to this point and then continue, the more confident I think you can be about a bull market having further upside from what we've seen so far. At this point, not seeing enough of on Netflix to declare that that's happening. Sort of a really interesting day for John Deere. We'll probably have to leave it here. This is one of the few stocks reporting earnings here at the end of this week, sort of out of the Q2 earnings season, and just a lot of consumer things randomly here over the coming weeks going forward. But Deere actually opened up pretty good, just above 390, traded right to its 200-day moving average, almost to the penny, and then rotated back lower, ended up making a new low for the year before closing a little bit above there. So if that tells you anything, that may be a John Deere specific issue, but it certainly tells me about the lack of follow through, right? A gap higher that a lot of investors see as a great opportunity to sell. That's not a great bull market feel for this particular stock. Again, the more that I see things like that, more than it makes me question the longevity of a bull market phase. Let's take a quick commercial break. We'll be back answering some of your questions from the Final Bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close. So many great plans for the Final Bar and for StockCharts TV in the coming months and years. Well, before we continue on with our show with our mailbag, just want to remind you our mailbag is fueled by questions from people like you. If you can email us your questions, anything you're running into as you're using the StockCharts platform, trying to use technical analysis or anything else, our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Check out our StockCharts TV YouTube channel. Put a comment below that video that you're watching. We'll hope to answer your question live on the air on Monday of next week. Upcoming guests, we have 3 really good guests this week. I tell you, people like Jeff Hirsch, Danielle Shea, Jesse Felder, they're fantastic. We have more solid guests next week queued up for you. On Tuesday, Doug Bush of Chart Smarter joining us from New York. On Wednesday, Andrew Thrasher of Thrasher Analytics. On Thursday, John Kosar, founder of Asbury Research in Chicago. Our next episode of The Pitch is going to air next Thursday, the 25th. I'll be moderating a conversation with Dave Landry, Mark Newton, and Joe Rabel. They've all done that show before. It's a lot of fun. 5 stock or ETF pitches each, and then we'll discuss them as a group. You'll leave with some really good ideas on plays and bets to make in this environment. Also to let you know, my next webcast for Market Misbehavior will be coming up next week on Tuesday the 23rd, 1 o'clock Eastern, called Sell in May, Trends versus Cycles. I had a great conversation yesterday with Jeff Hirsch, editor of the Stock Traders Almanac. Conversations with him have really reinforced the value of seasonal trends. We're going to look particularly at May through October what the history tells us, what the cycles traditionally tell us, and what the trends today should tell us about the market conditions relative to those normal cycles. You can sign up for that free event at marketmisbehavior.com/sell in May. I hope to see you there. Let's continue on our show today with the Final Bar mailbag. And here, let's get right into question number one. Dave, is there some way to scale RSI periods to show an N-day RSI on a weekly chart? I really appreciate your question. Maybe think a little bit about the relationship between different timeframes. You had a lot of information you share with me about, how different things can be scaled for different timeframes, and I totally agree. You had mentioned something that I use often, which is looking at daily moving averages on weekly charts or weekly moving averages on daily charts. And commonly on a daily chart, and this is the daily chart of the SPY going back for the last 5 years, I have the 50-day moving average in blue and the 200-day moving average in red. Now, I often refer to the 200-day moving average. So on a weekly chart, I actually look at the 40-week moving average because it's about the same, right? Instead of looking at 5 observations every week, you're looking at 1 observation every Friday, but overall the trends and the levels in general are very, very similar to one another. It gets a little murkier and a little more tougher to do things that easily when you get away from a simple calculation and start using exponential averages, which is what RSI actually does. I set up these 2 charts just to show you it can kind of be done, but it's not perfect. So this is a 5-year daily chart of the SPY, and at the bottom I'm doing a 30-period RSI. Now you can do this with other periods. I just picked the ones that I'm showing you here just to show how you can get the levels to line up pretty closely. So you can see the daily chart with the 30-day RSI. Chart number 2 is a weekly chart of the last 5 years, and I'm doing the 14-week RSI. I'm going to flip back and forth between the two of them, and if you glance around at different parts of the chart, you can see that while they're not identical, they're very, very close. Of course, the weekly price data in the bar chart matches the daily price data pretty closely. And if you look at the bottom, you can see that the weekly RSI with the 14 period matches pretty well with the daily RSI with the 30 periods. But it's not identical, and you'll find there are little inconsistencies, little changes, and the problem is you're only looking at 1 data point a week here versus 5 data points a week. The calculations are not exact, and there's no mathematical way to scale them exactly because you're looking at essentially a different data set. But my general comment to you was, yes, you can definitely do it. On a daily RSI, if you're going to a weekly RSI, a weekly chart, just do a much shorter scaling, right? So instead of a 14-period weekly, look at a 9-period or a 5-period or a 3-period. If you're looking at a daily one, use a longer period, and those will tend to match up a little bit better. So you can do it. It's not going to be as precise as you probably want, but you can do some ways to try to estimate those different relationships. Someone, and I forget who it was, one of the guests on our show actually has a chart where they have multiple RSI settings on the same chart as a way to show, the short-term to long-term, which I think is really interesting. It's on a deep list somewhere of rainy day charts to dig into. But thanks so much for that question, by the way. Next question, I love this one. Okay, Dave, what is a 9-13-9? This came from my conversation with Jesse Felder that was earlier in the week where we were talking about Tom DeMark's indicator and what's called a 9-13-9 pattern. I'll tell you what, I will do the quick version of trying to explain it to you, and give me a moment here. So I don't have a chart ready, but I can zoom into this chart, and I will find a time to show you exactly what we're trying to do here. So Tom DeMark's indicator is basically called the TD sequential, and this is one of hundreds that he's created. He just won the annual award from the CMT Association. I saw him again in New York after not seeing him since before COVID. That was actually pretty cool to reconnect with Tom. I'd worked with him a lot earlier in my career in my Bloomberg days. But here's what his indicator called TD sequential is actually trying to do. It starts with what's called a setup phase, which is basically 9 consecutive bars where you close higher than the close 4 bars earlier. And I'm looking at a daily candle chart of the SPY just to show you quickly how you can do that analysis. So basically, the first day that closes higher than the close 4 bars ago is this one right here. So you're comparing this close to 1, 2, 3, 4 bars ago. So that's day 1. Here's day 2, which is higher than that close. Day 3, which is higher than this one. And you can see as we go 4, 5, unfortunately, that doesn't do it. So we have to start over. 1, 2, 3, nope. 1, 2, 3, 4, 5, 6, 7, 8, 9, that's just barely it. So that would be 9 days where we close higher than the close 4 days earlier. And this is the analysis that's called the setup, which basically initiates. It tells you that we are now in an uptrend. From there, you start a countdown phase where you count 13 bars where the close is higher than the high 2 bars ago. And I don't expect this to be a complete tutorial on the TD sequential indicator, but it's basically doing a simple comparison of where we're at today versus the high or the low or the close 4 bars earlier, and the indicator has more information on all that. If you go to Tom DeMark's website, you can get a full description of the TD sequential indicator. What Jesse was referring to is what Tom calls the 9-13-9 pattern. I don't know if this is exactly it, so I don't want to say that it is, but basically you might have a 9-bar setup, a 13-bar countdown, and then instead of selling off, which it normally does, you have another 9-bar setup that completes. So it's 9, 13, 9, and it often would be the end of a big move. I don't have an example readily available. We don't have Tom's indicator programmed into the StockCharts platform at this point, so I can't show you a great example, but that is something that a lot in the hedge fund community often use. Steve Cohen, Paul Tudor Jones, famously, Peter Borish all worked with Tom, and we're early users of his technique. Now a lot more people have become familiar with it. So it's one of the many indicators. What I like about it is it's meant to identify trend exhaustion, which is actually pretty unusual. So that's what we were referring to. Again, Tom's website has a great primer and description of all of the details behind his indicators. Next question. Is the SPX making a tightening coil that will explode soon? I love the severity of your question, and this is the chart that you sent along with it. Thanks for sending a chart. By the way, if you're sending in a question, if you click just below the chart, there's a little thing that says permalink. Send me that hyperlink, and then I can look at exactly what you're looking at and bring it up on my own login. So is this a tightening coil that will explode soon? My short answer is I don't think so, only because I'm not seeing a coil pattern here. I think what you're looking at is maybe this sort of narrowing of the lower highs and the higher lows, and I get it. But why I don't like this is because these levels in here, this high and this low, don't really fit with it. So it's not a perfect sort of pattern. A coil pattern is really where you have lower highs and higher lows, and it's really consistent, where you can draw a trend line that connect multiple highs and connect a trend line with multiple lows. I think what you're capturing, I think what you're looking at is this a breakout above that pattern? And I would say it is a break above trendline resistance. That's undeniable. Is it a coil pattern? I wouldn't necessarily agree with that labeling of this. But the fact that we've broken above that trend line, I think, is important. We actually first talked about that back here in October, off the October lows, when we broke above the trend line, connecting the highs in 2022. That was the last big, thick green trend line that I had on my chart. Now it's a horizontal line at 4,200. So I get what you're thinking. I wouldn't label it as a coil, but I would agree that the recent breakout certainly seems to be a follow-through. Getting above 4,200, I still think, is an important level to follow through on. Next question. What is a single stock ETF, and what's the purpose compared to just owning the stock outright? That's a really interesting question. So what I will tell you is this comes from the fact, in my own opinion, is the financial industry is incredibly good at convincing you that you need something and then giving you a product that costs you money to allow yourself to access that technique or that approach. And I think this is sort of one of those. So so Tesla, let's take Tesla as an example, right? This is the chart of Tesla, the common stock, which you could obviously buy in a brokerage account wherever you would normally buy or sell stocks. Now, ETF providers have basically created leveraged long Tesla ETFs and short Tesla ETFs, and actually some other more complex structures. I think it's Direction Funds has TSLL, which is a 1.5 times long Tesla ETF. You have TSLS, which is a short Tesla ETF. You even have TSLH, which uses derivatives to make a hedged Tesla, where you limit your upside, but you also limit your downside. That's an innovator ETF. So there are ways to do that, and these really came from the leveraged and inverse ETFs that are based on indexes and commodities, right? You know, we have the triple long and triple short Qs and S&P and all of those. My real question for any of you thinking about those is, do we really need those? And I think that's the most important question to watch. My general comment on something like anything that I just showed you is, number one, these are good for short-term. They're really designed for short-term trading. They are not optimized for long-term holding periods, nor would I suggest you even consider that, because they're meant to mirror and be based off of the day-to-day percentage moves. Over time, that relationship can decay, and all of a sudden you're getting exposure that you don't really want. I'm never a fan of getting exposure that is unintended over time, and that's what these products unfortunately can do. So the other things I would say are 3 issues with any sort of leverage or inverse ETF, not just these, but any of them, are expenses, liquidity, and structural issues. The expenses tend to be a little more expensive, right? So you're probably paying 1.5% as opposed to almost nothing for a regular ETF. The liquidity, right? If you look at the chart of TSLH, it's just not very liquid. There's not a lot of volume, which means the bid-ask spread is probably going to be a little wider than you want. Getting in and out of these quickly may be an issue, and liquidity can certainly be a problem because they're not widely held so much. I wouldn't be surprised if some of these don't stand the test of time and end up not having enough liquidity to stay active. And structural issues. You have to remember that these don't hold the underlying stock necessarily, most likely not. They use derivatives, they use interest rate swaps and other things to recreate this pattern. And that just means you're exposing yourself to some other structures which may or may not be stable. So there are ways you can do. There are no, by the way, your single stock ETFs really don't provide the same exposure as an equity. So if you want to buy Tesla, I would be looking at Tesla as an example. I would not be using one of those leveraged or short products. But that's what they're doing, is basically playing off of the performance of Tesla, using derivatives to give you some other relationship. But again, I would be thinking about those issues that I mentioned earlier. We need to wrap the show, folks, and go right to the 3 in 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. I'm looking at breadth indicators. We talked with a number of my guests. Jeff Hirsch yesterday mentioned, lack of breadth support. A number of my guests over the last couple of weeks, we've talked about breadth conditions, sort of idea of narrow leadership, which I would argue still is very much a relevant thing to be thinking about here. One of the ways that I was thinking about it earlier today as I was preparing for the show is look at the S&P 500 on a closing basis. Look at that 4,200 level we've been talking about. This is a little lower. It's around 4,170, 4,180 that I have with this green horizontal line. Now look at the same trend, the same time frame, but the trend in the stocks above the 200-day moving average. In February, it was about 80% of the S&P stocks above their 200-day. Here in mid-April, it was around 65, 62% of stocks above the S&P, above their 50-day, their 200-day moving average. Currently, as the S&P is now breaking above that trend line and testing 4,200, it's at 50%. So every time we've tested this 4,200 level, there have been less and less members of the S&P above their 200-day moving average. That is not an encouraging sign for me. A rotation higher in the market should be matched by a rotation higher in breadth indicators. Otherwise, I think you have to worry about a lack of breadth support. I think that is very much a concern here in May of 2023. Chart number 2 is Netflix. It's not just the S&P testing 4,200. It's a lot of individual names. It's a lot of sectors and groups that are testing resistance as well. The chart of Netflix shows a peak in February around 370. You can see we pulled back, of course, in March. We made a higher low in April. That's pretty constructive, but now we're retesting that level. I'm super encouraged that we've round-tripped from the low in March back to the peak in February, but I am questioning whether or not we get through there. It's still an open question. I'm not saying we won't get there. I'm just saying we haven't yet. And I think for me, as we test resistance, it's all about the follow-through. These are the types of charts I like to put in a watch list and start to review them over time. These are where I like to set price alerts on StockCharts for it to text me on my phone when it actually does break above that key level. So I have an alert for Netflix at 375. I'd encourage you to do the same because that's a great way to not have to stare at this chart all the time, but to recognize and confirm when that breakout has actually occurred. The final one is the chart of Ulta Home Beauties, ULTA, and I wanted to just show that while the S&P is breaking out, while Netflix and charts like it are testing resistance, there are other stocks that don't look like that. And I think that's one of the most interesting parts about looking at equities, looking at ETFs, right? It's not just about the S&P, the NASDAQ, the high-level indexes. It's also about the individual names that comprise those indexes. And there have been outliers to the upsides that are breaking out. There have been outliers to the downside breaking down. I saw plenty of names making new 3-month highs when I ran that scan yesterday morning. I saw plenty of stocks making new 3-month lows as well. Ulta is one of those, making a new 3-month low this week. It broke below 500. That takes us below the March low, and that's after failing to eclipse the March and April highs. Folks, that's a wrap for this week. Thank you so much for joining us every weekday after the close for the Final Bar. All of our previous interviews are at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you on Monday.